Hey folks, welcome back to the channel. It does look like I am live. Um, Once again, I was having some technology issues. Not sure if my microphone is working. I'll just start talking, and one of you will let me know sooner or later if you can hear anything. Yeah, let's talk about what's going on in markets today. Fintechs are actually on fire. It has something to do with SoFi, of course, but it probably has more to do with PayPal. And I'll tell you one thing: SoFi's earnings, in terms of scale versus relative to their size, are actually a lot more impressive than PayPal's, and we can talk about why that is. I did do a video earlier today on the SoFi earnings release and just how impressive it is. Since I don't really get excited or emotional about much, maybe you couldn't tell just how much of a beat this was. They really spanked the living daylights out of even not just analyst expectations, but I think most people expected them to really suffer this quarter, and that wasn't the case. Their business is marching along just as it should be. But the narrowing year over year loss is what I'm really looking at. They're going from earnings per share of negative 48 cents last year in this quarter to negative 12 cents. Their pathway to profitability looks like it's fairly solid. Now, I don't expect them to be profitable immediately because they're probably going to make one or two more acquisitions in the next year or so, which is going to have one-time effects on profitability, just like it did in first quarter of this year when they acquired the bank and they acquired, I can't remember the other name of the company that they acquired. It was a technology company. But also, thank you, Elon, for letting me know that everything is loud and clear. As clear as I can make it, since I don't actually have like a radio or a television voice. But fire away with the questions today. We're just going to take a quick look at what markets are doing right now. Markets are up all across the board. The NASDAQ 100 is up 370 points right now, almost 3%. That is being led, of course, by tech stocks, but more particularly fintech stocks. And this was really set off by PayPal, and then SoFi kind of piled on there. And remember, Square reports earnings tomorrow. I do not expect Square's earnings to look as good as PayPal, and I don't expect them to look as good as SoFi. So PayPal's earnings were really a case of it wasn't as bad as we feared. Square's earnings are probably going to miss expectations, in my opinion. And SoFi's earnings they blew away expectations at pretty much every level. So, hey, Bram, good afternoon. Happy to see you guys, my regulars here. Just want to remind everyone, of course, that the super chat features are on if you feel so inclined. Also, if you guys want to one day try out my Patreon, that would be awesome. The link is not in the description because I forgot to put it in there, but it's in the description from the video I made this morning. And I'll go back and put it in this description as well. Happy to answer any questions, but looking at today's markets, we are just coming to a close right now. The Dow Jones is up 413 points, about 1.3%. Russell 2000 up 1.6, and the S&P 500 up 1.6. The rally is fairly broad today, meaning a lot of it is just simply market driven. It's not driven particularly by individual company news, but generally the feeling that earnings are not as bad as we thought they were going to be, which is very different than earnings were very solid. And let's take a look at what I mean when it comes to PayPal's earnings. This is a pretty important bellwether, and this is the one that really kind of sparked the rally. So, yeah. And I'm going to get to this question here, Elon's, and it was actually addressed in my video and that I made earlier today, but we'll talk about that too. So second quarter earnings for PayPal is, and I don't know one thing why they do this, and they should probably stop doing it. But Q2 2022 earnings delivered solid financial results and sequential revenue acceleration. Net revenues of 6.8 billion, growing 9% and 10% on a foreign exchange neutral basis. They call this FXN. Excluding eBay, revenue grew 14% on a spot basis. So this is an international company that handles international payments. There's absolutely no reason to exclude things or do things on a foreign exchange neutral basis because foreign exchange is not neutral. The foreign exchange rates are floating. So your results are your results, and you shouldn't be comparing it to just the American dollar if the American dollar was stable. So I don't, that's kind of ridiculous. And they should stop doing that because it gives folks a false idea of total payment volume because this is an international company. So operating cash flow of 1.5 billion growing 12% and free cash flow of 1.3 billion growing 22%. That's great, by the way, and that free cash flow increase is really a result of cost cutting, which made the headlines about $900 million in cost cutting for the quarter. So total payment volume was 339.8 billion, growing 9% and 13% on a foreign exchange neutral basis. Which I'm going to stop saying that because, like I said, I think it's only important because it makes things look better than they actually are. So 9% growth quarter over quarter is not terrible, but this is companies behaving a little bit more like a mature financial services company at this point. So, yeah, go over a couple of management changes, and let's talk about revenue. So revenue expected to reach 27.85 billion with a TPV of 1.4, which a total enterprise value or whatever of 1.4 trillion. Net revenues are expected to grow around 10% on a spot basis, and GAAP earning EPS is expected to be 1.52 to 1.62, raising expected non-GAAP EPS earnings per share 3.87 to 3.97. So the expected TPV is expected to grow around 12% on the spot basis. So approximately 10 million net new actives, which I don't remember exactly how they describe net new actives, but that's what they expect to be added in 2022. So net revenues, 6.8 billion, up 9%. We cover that. Operating income at year-over-year change is down by 32%. Earnings per share, of course, is down 129% in this case. And on a non-GAAP basis, it's only down 19%. So these are metrics that may get you a little bit confused here. So it's actually better to see the visualization here when we look at this. Total payment volume is up 9%. Ignore this number on a foreign exchange basis. Let's just look at this right here in terms of the actual dollars as you, an investor, are seeing. This is if we take into account the foreign exchange. So net revenues are up 9%. GAAP revenue, like I said, is down to 29 cents, or negative 29 cents on the dollar, and it was $1 last year on per share, and now it's down 29 to negative 29 cents. And non-GAAP revenue is down 19% here. So operating cash flow versus free cash flow, like I said, this is mostly a result of cost cutting. So net revenues increased 9% with ex-eBay growth of 14%, meaning excluding eBay growth. I think it's a very positive sign, but one that it's acting a lot less like a new startup and more like a mature company at this point. So excluding eBay, the company grew by 11% on a spot basis and 15% on a foreign exchange neutral basis, representing 98% of the total enterprise value of the company. So about 4 million or 0.4 million net new actives added, with a total active accounts of 429 million, up 6% or so. Like I said, these are good numbers. These are solid numbers, but maybe the company's no longer performing or acting like it's in that growth mode. So that's just kind of one of the things I wanted to talk about. This is a company that I do hold. I have like 100 shares in it. I'm down kind of pretty far on this, but getting close to even here. So with my PayPal stock, but this is a long-term hold for me. So strong balance sheet and cash flow generation, cash equivalents and investments added to total of 15.6 billion as of June 30th, 2020. They got plenty of cushion there. Debt totaled 10.6 billion as of June 30th, 2022, including 3 billion of new issuance in May of 2022. Those were probably some of the last bonds that were issued on the market, because I know that in June there were almost no investment grade bonds that were issued in June. There were very, very few. So in Q2 of 2022, they repurchased approximately 8 million shares of common stock, returning 750 million to stockholders. I think their plan is to do $12 billion over the next couple of years of stock buybacks, which is a good sign for shareholders. This is one of the things that may be a little bit confusing for people. SoFi and PayPal really aren't engaged in all of the same services or all of the same strategy, but there's a bunch of new strategic initiatives that PayPal is rolling out. They're rolling out new credit cards, including PayPal Business Cashback MasterCard, and expansion of PayPal Working Capital, which is a short-term loan facility. They're extending that to France and the Netherlands, and which is not all that exciting, considering that their interest rates are so incredibly low in France and the Netherlands right now, much lower than they are here, and they've been that way for quite some time. So, it was really at the beginning of the year. Europe was literally just coming out of a really long recession that began for them, or really long, a period of stagnation, which began for them in 2008. They were really sort of emerging from that. Folks were talking a little bit about raising interest rates in that case, and we were getting back to an era where we might see a normalized interest rate environment in Europe, and then the war in Ukraine happened. So I'm sure this is planned long before it was executed this quarter. I'm a little bit less excited about that at this point. So they launched crypto transfers between PayPal and other wallets and exchanges, which also has come back to bite them right now, as well as a no-fee send and receive to family and friends on PayPal in the US. That's actually pretty interesting, enhancing the cryptocurrency value proposition and expanding the broader ecosystem. Expanded the relationship with Shopify to power Shopify payments in France. Broaden the global pay later offerings, launching monthly or pay monthly in the US, giving customers a choice to spread payments over a longer period of time, and providing merchants with a new way to engage more customers. And of course, this is a way to generate interest income. So if we look at the highlights here, what we're seeing is growth. It's solid growth. It is not as exciting as it once was. Okay. And I really don't care about the leadership positions here. So yeah. So let's talk about this. So basically, SoFi has discounted the student loan debt. It's about 25% of the business that they were doing in 2019, meaning that the total volume of what they're doing in the student loan business is only a quarter of what they were doing in 2019, and their revenue still absolutely blew through expectations. And a lot of that had to do with the other lines of business now providing more and more in the way of income. And what I'm talking about is financial services and their technology platform. And financial services really led the way. In fact, if you look at the graph, it looks like they're kind of at the beginning of an exponential curve upward there. And that is their SoFi Credit, SoFi Banking, SoFi Relay, SoFi at Business. Of course, their invest programs, all that. So all of those, they basically doubled their income on every one of those segments of business in the last year. And that is the real story there. So I don't have a way of quantifying the dollar amount that each new account on the technology platform brings in, but their accounts have basically doubled over the last year as well. So yeah. So hi guys, is Tesla building a cell phone? Honestly, that would seem like the next natural step, but I'm not sure what capabilities the cell phone would have that the car can't have by itself, right? So I'm not sure why they would do that. It does seem like the next natural step, though. I'm not sure how much more functionality though it would actually have. So back to this right here, though. I'm fairly certain that SoFi is planning on a really substantial amount of forgiveness of student debt. That has to be coming soon. Possibly before midterms, we're going to see a lot more student debt being forgiven here, which would, of course, impact. But I think they've already discounted this in their future projections. So a lot of the student debt that's probably being refinanced right now is already debt that is privately held and that would not have been affected by student loan moratoriums anyway. Since you're not from the United States, you probably, or you might not know that out of the $1.7 trillion of student debt in the United States, which is literally larger than the GDP of many countries in Europe, we're looking at a large portion not being owned by the federal government. Something like 92% of student loans is actually owned by the U.S. Treasury Department, and about 8% of it now is private student loans. Those private student loans have not benefited from anything in student loan forgiveness at all. Those folks still have to make their payments. And those folks who are trapped in that can refinance their debt through SoFi, and that's who they used to target in the past. I think that who their customer is evolving over time. That student loans were a great way to build that initial customer base, and now they're really driving hard after that high net worth, not well served individual. So, yeah, looking forward to seeing what they have next quarter. Already looking forward to that. Right. Yeah. Okay. So back to Tesla here. I could totally see why they would. If driving becomes more automated, cars become more of an entertainment space served by subscriptions. Well, that is definitely something that I should probably consider too. Yeah, definitely I should consider that too. So there's always angles with new handheld technology that I certainly don't think of ahead of time. So yeah, if Tesla builds a cell phone, Apple will want to make one too. Apple will want to make a car too, right? So I did a video like 2 years ago on the potential for an Apple car, and that video exploded. I was on like 30,000 views or something ridiculous like that. But there hasn't been a ton of news to come out of, or a ton of leaks to come out of that in the last couple of years. So I don't have any good information that's verifiable at this point. So, yeah. So, yeah, I guess I should have shared my screen and showing you guys what I was reading before. Occasionally, I forget to do that. Do you think Noto's estimate of 29 trillion of total asset or of total addressable market for B2B was accurate or hype? Would you dare to hazard a rough guess about what percentage they would take? No, I'm not going to dare to hazard. I think total addressable market is completely is completely accurate or reasonable, at least. Would I dare to hazard a rough guess about how much percentage they're going to take? Not really. If you look at the percentage of any bank in the financial services arena and how much they take, that that take is usually pretty small, right? And most people have bank accounts at multiple institutions because they just can't get served everything they need at a single institution. And so the winner in this space is going to be winner who takes most, not winner who dominates others and puts everyone out of business, right? They're also going to, because they're in a strong cash position as well, they're probably going to have an offering of convertible bonds at some point. Expect them to start acquiring more banks as well, not just so they can, so they could have sped up the process for a charter or anything like that, but they want access to those loan portfolios. They want access to that deposit base and all that stuff. I think that SoFi is likely to have more of a brick and mortar presence here in the future than you'd think. So, yeah. So, how do you think a recession? So, Hugh Nawachukwu, I don't know how to pronounce your name. I hope I'm getting it right. Is it Hugh or Oog? I'm not sure. Either the French or the English pronunciation. But how do you think a recession would affect fintechs and lending apps? Well, of course, they're going to go down. And fintechs, for the most part, have been relatively unjustly punished by the rest of the market declining. They were down anywhere from 50 to 90% off of their highs just a year ago. And a lot of that was not driven by company specific news. It was driven entirely by market news, which also means that there's going to be a quick snapback, as we've witnessed in the last couple of days or so. There's a quick snapback in these funds. In the last month or so, I think Square has been up almost 20%. Of course, 27% for SoFi today, but they're a small player in terms of market cap and in terms of overall volume in the fintech space. So a couple of things to look out for, though. Like I was talking about Square earlier, I don't think their earnings are going to look terrible. I think they're going to be they're going to miss estimates by a little bit. I think they're going to not be as horrible as they could be. And then after that comes Upstart. I think Upstart is on the 8th, and then Affirm is releasing on the 25th. So Upstart, I expect, is going to have a bad quarter. And this is one of the reasons I started investing in them when their stock is down 25-30% in the last month. So I've started acquiring Upstart. So Upstart's down quarter is really going to be a one-time charge. So they don't really keep loans on their books at this point, but they had a number of loans on their books. Investors got a little bit nervous and they asked them to dispose of those loans. They ended up selling on the market, probably taking a loss to do so. How much that loss is and how much that ride down, we don't really know. But they make their money by with loan originations and with fees from loan originations, and they generally package up those loans for someone else to hold on their balance sheet, or they package them up and securitize them, right? So, and sometimes you securitize those and sell those at a loss. That just happens sometimes. But that is next, and I expect that to be not a great quarter for Upstart. Now, I've been slowly acquiring Upstart. I have a couple hundred shares now. I've got a $20 put out there expiring on August 19th for, I think, 20 or something like that. I'm happy to own it at 20. I think this company is going to snap back rather quickly next quarter and the quarters after that, as lenders do really well in eras of high inflation and rising interest rates. Not necessarily high inflation over the long term, but in shock moments like this. But they really do well in eras of high interest rates. So that's one of the things I'm looking at. I'm investing a little bit more heavily in some traditional financials as well as fintechs in this case. Have been so far underwater for a very long time on SoFi, though. Think very carefully. This stock is really volatile. Think very carefully as far as whether or not you want to get into it. I think this is a multi-year wait for return. I think they're likely to be profitable early 2024, late 2023, and that's kind of the best you can hope for. But the trend line is showing they're going to be profitable. They're going to, and I think there's going to be a hiccup or two with an acquisition or two that they make sometime next year. I don't know who they're targeting for acquisition, but yeah. So today's markets, the trip to Taiwan by Nancy Pelosi turned out to largely have no effect whatsoever. Oil prices have been tanking, of course, but oil stocks are gaining, and there's a bunch of those answered. But we can take a look at how I was reading somewhere that this Nancy Pelosi's flight was the most watched flight in history, and I thought that was interesting, but I don't know why it was the most watched flight in history. So Nancy Pelosi's visit to Taiwan has ratcheted up U.S.-Chinese tensions to a new level. I don't believe that's actually true. I think there's a bunch of posturing that's going on. Of course, they instituted a bunch of drills while Nancy Pelosi was there, and they see it as a pattern of comments from U.S. officials over the past 6 years that undermines the decades-long ambiguity about Taiwan. I don't think they realize that we don't have patterns of communications. Our politicians can say whatever the heck they want, and often they say a bunch of dumb things. So that's just my opinion. But I think this is a clear sign that we're not going to abandon Taiwan should Russia decide to pull a Ukraine on them. And but I think that they knew this was coming, and they're not really doing anything that they weren't expected to do. They've done some live fire naval exercises, and they've run some air exercises. They buzzed by, but really, people are looking at Taiwan because of chips. They make the majority of the world's chips at this point. Actually, I don't know if it's a majority anymore, but it's a significant portion. And this is a sensitive time for the U.S. economy. The U.S. economy is still fragile. Even though the stock market has looked really good over the last couple of weeks, there is a chance that this is a bear market bounce and nothing more. And I don't think you should get too excited or be too surprised if we see some of these gains evaporate over the next couple of weeks. So let me know what you guys think about that assessment. Fire away with comments. I gave you guys a quick look at PayPal's earnings. Unfortunately, I didn't have it up on the screen while I was doing that. But if you have any questions, let me know. This is going to be a shorter session today, as I was kind of planning to do the Tyrion Lannister thing today, which is drink on the live stream and know things. Unfortunately, I partied a little bit too much. So what is your view on the deglobalization trend? Are you expecting a prolonged recession or a quick recovery? So whether or not we have a prolonged recession or a shallow recession really depends on geopolitical events right now and how much that's going to disrupt supply chains. So I don't know if you are a longtime watcher of my channel, but the opinion that I have is that almost all of this is related to supply shock. And a lot of that has to do with the history of the last 6 or 7 inflation events. They were almost all due to supply shock or energy prices being raised. And I'm talking about events, 1945, 46, 49 to 50, 53, 68 to 73, 73 to 70 to 82. Again, in the early 2000s, right before the dot-com crash, and again in 2008, almost always due to either a spike in energy prices or supply shock, meaning there was just too much demand and supply couldn't be satisfied, so prices rose. Had a lot less to do with the printing of money or anything like that. That can definitely cause inflation over the long term. There is no correlation with that in the U.S. economy at this point. That's not to say it won't in the future. We have to do something about our expanding money supply, but that is an answer for a different live stream, maybe a series of videos. I don't know, maybe a book. But the deglobalization trend, so I'm not overly concerned with the deglobalization trend. I think a lot of high dollar items pretty far up on the manufacturing scale with large margins, Some of that can be absorbed with some of the labor costs can be absorbed by automation and robots and things like that. That's going to be reshored here in the United States, especially some critical things like chips are going to be reshored here in the United States. But anything that is seriously commoditized that we need billions of, it's going to stay in China or Pakistan, or maybe new manufacturing facilities built around the world where labor is very cheap. That's probably what's likely to happen. So, and I've talked about this on my channel before, that when it comes to things like textiles, when it comes to things like plastics, there is no competing with what can be made overseas. When it comes to something that is manufactured in volume, I've tried to get the best price for things using American producers. They won't work with you, probably because they cannot work with you beyond a certain price, and which means they're destined to always be competing against the headwinds of companies that pay their workers, $5 a day or something like that. By the way, thank you for the Moderna recommendation. It's the only green in my portfolio. So I don't specifically recommend stocks on this channel. I talk about stocks that I like. Nothing is meant as a recommendation for any individual to buy, sell, or hold any security. But I have talked about Moderna a bunch. For me, it is an extremely long-term hold. I don't really care that much about the price on a day-to-day basis. I'm not really overly excited about the green in the portfolio at this moment. I'm really excited about things that are coming for them 5-10 years down the road. Things like the AIDS vaccine that they're testing right now. Not excited at all really about a monkeypox virus vaccine or anything like that. That vaccine already exists. Somebody just needs to produce it. But I am interested in a lot of their research, and some new and very interesting discoveries have been made regarding protein folding as well, which Moderna would be able to exploit, largely because they produce mRNA. mRNA is fed into a ribosome. The ribosomes are what synthesize proteins, and it's these misfolded proteins that cause a lot of diseases in humans. I think something like, I don't know if this is, I think this statistic may or may not be true, but something like 15 to 20% of all diseases in advanced age are due to possibly to malformed proteins. So I read that on an article years ago. I don't know how true that really is, but this could be very large for a lot of diseases that are out there. So if we are in a relief rally, what should we expect in the short term, medium term? More choppiness. Like we lost 400 points on Tuesday or something like that. I think we could be back to that by tomorrow when Square's earnings come out looking not so great. I really hope I'm wrong about Square's earnings. I hope they look great, but they're in the middle of a transition here and sort of refocusing their business. And to me, it's only natural that they would have some struggles. And for folks that are extremely short-sighted, or folks who are short-term traders, they're of course going to create that volatility that you as a long-term investor can take advantage of. I was grabbing shares at $155 a share of NVIDIA, grabbing PayPal shares at $75, grabbing a little bit more SoFi at a little bit less than $6 a share. Let me see here. Hey, Jason, what are your thoughts on Devon Energy stock? Do you have any oil stocks? I don't hear. Actually, I have plenty of energy stocks. And a lot of it's because I used to work for the oil industry, so some of that is kind of legacy holdings. I tend not to buy individual stocks in oil anymore, and not to do further investing in energy stocks, just because I think oil is going to be around in the economy for a very, very long time. It's not going anywhere. There's going to be demand for oil, but I think we've pretty much reached peak demand in this country. And demand is slowly going to leak out of transportation over the next decade or so. But still, 26%, 27% of all oil consumption in the United States is not related to transportation. The rest of it is related to transportation, whether that's manufacturing the vehicle, whether that's lubricating it, whether that's burning for energy, whatever it is. Basically, 74% of all oil production in the United States is related to transportation. As we're electrifying more and more, there are going to be winners and there are going to be a lot of losers in oil in the future. It may be and I think the largest companies are going to do the best. They're going to be able to make that transition, and they're going to be able to reconcentrate their businesses. They're going to end up swallowing up a lot of companies whole. So when I'm looking at Devon Energy here, I haven't looked at them in a while. I want to make sure they're pipeline producer or midstream. What are they? Yeah, they engage in exploration, development, production of oil, natural gas liquids. And it operates approximately 5,134 gross wells. Devon Energy was incorporated in 1971. So they do that description of them is not entirely accurate. They do more operation of wells than they do wildcatting and exploration, right? So they're operating wells that they've either bought from someone else or they drilled themselves a while ago, but it's really operation wells. And you can tell that largely by the giant dividend that they have here at about 8.8%. Devon Energy is not one of those that I've followed closely over the years, but it's a solid company. They've been around for quite some time. It's a well-managed company. It's managed by veterans in the industry. Earnings per share at 5.35. The beta is super high on this. How is this company set up, though? I don't know if this company is it might be a master limited partnership. I'm not sure. If it is a master limited partnership, they have certain tax regulations that require that 90% of the income of the company is going to be redistributed back to the shareholders, which means that earnings per share can be pretty misleading. Price of earnings can be pretty misleading. But this monthly beta is like super high. Super high. Let's take a look at that. Yeah, this stock has been all over the place since the beginning of this year. Had a nice trend line upwards and then kind of dropped like a rock there. The dividend is nice. The dividend is nice. When I'm looking at this on a 5-year basis, or looking at this on a 10-year base, on a lifetime basis, it looks like there's some trading opportunity in there, but it's almost perfectly correlated to the price of oil here. So, yeah, so it's almost perfectly correlated to the price of oil here. It doesn't seem to have a lot of trading characteristics that aren't correlated to the price of oil, which means there are about 100 companies out there that are probably going to perform almost exactly the same as this. And it would be hard for me to pick this company and say it's going to have an advantage over any of the others. So, yeah, and I bet if I did an overlay of oil prices in this time frame, you'd see almost an exact correlation. So, and if you see the price of this this company right here, this is the recession, the top of the market in 2008. It was really, the top of the economy at least. That's when prices per barrel reached close to, I think it was 147 was the top price on the highest day, and that would have been in June of 2008. This is again in 2011 when we saw a spike before production came back online. April 2004. Yeah, this is almost perfectly. And this is the bottom here, which is September 1st, 2020, which is the bottom. But you saw this decline start in earlier than that in 2020. This big, well, it's not a big drop here. Let's see if I can look this on the 5-year. When we see December of 2019 and we see this big drop, that was the result of Russia starting to pump as much oil as they could in order to put American shale producers out of business because they were taking too much market share. That's not a conspiracy. That is absolutely what Putin said live on the news, is that we want to take market share away from American shale producers. They're going to go out of business if we keep the price of oil below $50 a barrel or $30 a barrel, whatever his target was. When the pandemic happened, though, the price of oil dropped significantly. This company was affected by this. So most of their money is generated from operating wells, and I don't think they do as much oil exploration as their description would suggest. But let's happy to talk about any other stocks that you guys want to talk about in the energy sector. Not a bad choice at all, but not substantially different from 100 other choices in that particular industry. Yeah, fire away any other questions, guys. I think I'm going to be on for another 15 or 20 minutes, and that is about it. And then I'm hopping off. Let me see here. Daniel says, do you think some real estate investors will rotate into stocks? Well, I'm sure some of them will, but there's more of a separation between real estate investors and stock investors than people think. The big real estate investors with big money tend not to hold as much in the way of stocks as you might think. And a lot of it's because they're very into using leverage in order to invest, right? Very, very much into using leverage to get what they want. And your use of leverage is limited in a stock account to roughly 25% equity, and you don't get as many tax benefits as you do with owning a mortgage. and you can't silo your credit liability like you can with real estate, right? And it's not secured by anything, and your rates are higher. So there tends to be more of a separation than with people who invest the vast majority of their net worth into real estate and folks who invest the vast majority of their net worth into stocks. Like if I lived outside of California, the vast majority of my net worth would be invested in stocks and not real estate, just by virtue of the fact that I live in California and I've owned property here for the last 25 years or so. Has meant that roughly half of my net worth is in real estate and half of it is in stocks, right, and other assets and businesses as well. You know what? I never even considered the value of my businesses in terms of what they're actually worth. That's just something that doesn't enter my mental calculations. At some point, I actually have to start doing that. But yes, so I don't think that a ton of investors are going to rotate into stocks. I really don't. So what do I think about Walker and Dunlop stock here? So let me see here. So nice dividend of 2.14%. That's generally what would be considered a sustainable dividend for a company like this. Hold on. They originate, sell, and service a large range of multifamily and other commercial real estate financing products and services for owners. Okay. So this company provides commercial real estate financing products and services for owners and developers of real estate in the United States. They offer first mortgage and second trust, supplemental construction, mezzanine, preferred equity. So this is a company that I might wait a little bit on before investing in. I think there's going to be a little bit more volatility in this stock before it starts to look much better to invest in. If you see, they had a pretty hard dip here down to $92 a share. Even though their earnings per share looks solid, their PDE ratio 13.56, which for this industry would be right about normal, right? This would be considered relatively fairly valued. Their beta is a little bit higher than the market over the last 5 years, and it's got a market cap of 3.76 billion. Volume for a company this size is a little bit low. There's enough in there that we're probably getting a fair estimation of what the actual value of the company is, but it is a little bit low. This company is billed as being undervalued, and that's right now because of the low price to earnings ratio. They do pay, like I said, they do pay that solid dividend as well. If I'm looking at earnings history here, the last 4 quarters, they beat 3 out of the last 4 quarters, especially in the last 3 quarters, it looked good. Earnings growth over time, revenue growth has gone from about 700 million to 1.26 billion over the last 4 years. Solid growth, as well as profitability has increased as well. These are all very good signs. I do think, though, they may have a rocky road here in the future just because of what's going on with interest rates. So I do think that is, I think that is coming, and it would probably be a better opportunity to invest then. I think the market is a little bit delusional about how much the Federal Reserve is going to raise interest rates. I don't know if folks are kind of planning on them, taking the foot off the pedal here. I don't think so. I think by the end of the year that the federal funds rate is going to be north of 3.5%, probably 4%, right? And that's going to put the brakes on the economy in a hard way. It's going to raise unemployment up to the 5 to 6% range, which is, I think, the goal of the Federal Reserve. That's what they want. And Stephen Kua, thank you so much for the super chat. Like I said, I always appreciate it when I get those. Just because you ask a question, you don't have to like throw me a super chat, but I really appreciate it when you do. So everyone, feel free to ask questions, and I'll always highlight the super chats when I get those. I was watching someone else's live stream, and it was a political live stream, and I don't generally comment on those because I don't want my comments to be public. But I did notice that people were throwing this guy like super chats so quickly that he couldn't even mention them all. And it was just a weird kind of thing. One of these days, I'd love to get to that level where I've got 50,000 people on or something. Never going to happen though. All right, Eric M., what's the most you've been levered up? That's an interesting question. So I tend to use a little bit less leverage than most people do on real estate, and a little bit less leverage than most people do in my stock accounts. The worst disasters that I've seen in brokerage accounts have been when folks had margin calls. It doesn't matter that I'm a long-term investor and I'm willing to hold. The minute you drop below 30% equity or 25% equity, depending on the stock, and some stocks, if you drop below 40% equity, then you're going to get a margin call, and you have to sell something to satisfy that margin at that time. And this is kind of what was starting to happen in May or so. We started to see margin calls increase and people were being forced to liquidate, and that exacerbated the market going down as well. And it's going to drag more people in the market into margin calls. So the max I like to be is at around 50%. I hate selling stock, but when I get more than, if I get below 50% in total equity from my account, I'm going to start selling things, selling things to reduce that. In terms of real estate, if it's a private home that I'm going to live in, meaning it's my primary home, then I'll lever up as much as they'll let me. If they would allow me to put 3% down on a home like you can for a first time home purchase, I would do that. But when it comes to a rental property, I tend to put like 30 or 40% down. And once I've had a renter in there for a couple of years, I'll turn around and take a second mortgage on that property and strike that out then. But and the initial purchase, I want immediate cash flow. I want to put 30 or 40% down and start making a profit immediately, just to have that expense being covered, in case I were to lose an income stream or two. At least it's not costing me anything. And then as I get more comfortable and as rates rise or as equity increases in the property, then I'll go out and I'll take out a loan up to 70% on that property sometimes. So but that's kind of my own personal strategy to reduce risk. I'm not exactly risk adverse when you look at all of the actual businesses that I own, but maybe I'm a little bit more risk adverse when it comes to using leverage for my businesses. So, or for my real estate business or for my stock portfolio. But yeah, that's a question right now. Like, how much am I levered right now? That's actually hard to answer because after 2020, of course, I have EIDL loans that have to be paid back for a couple of my businesses. Did get the PPP loans forgiven, but the EIDL loans have to be paid back. So I would have to look that up and see how much we're levered in that respect. But in terms of property, my current home, I probably have I only owe like 30% of what it's worth on my current home that I live in. On my one of my rental properties here, I probably owe 25% of what it's worth, and which puts me in a really good position because I'm going to be able to have access to a lot of credit coming out of whatever market correction we're going into right now. So I keep saying that I really don't like being a landlord. I really don't want any more rental properties, but the ability to use leverage is making a property look not attractive right now, but about a year from now, maybe by May of next year or up to a year after that, I think that I may be acquiring another rental property just because I think it's just going to be too much of an opportunity not to do that. So yeah, that's a good question though, is how much you've been levered up. The more you have, the more access to leverage you have, but I don't know what minimums are on accounts now for margin, but think very carefully about margin, especially combining margin and options. I actually tend to use my margin to sell puts to acquire stock at the price that I want to acquire it at. Like my target price for acquisition, I'll sell a put at that and I'll make, a couple $100 in premium. I take that premium and I go buy something else. But I'll use a put to do that. And then once I sell that, once that put gets executed, now I owe that stock, but now I'm also, I'm also in the red in terms of my margin. So yeah, that's a very interesting question. If you guys, one of these days I'll do a video on how margin increases your gains, but how margin can come and bite you in the butt too. So yeah. But anyway, I want to thank you guys for coming on the live stream today. I'm going to cut this one short because I got a bunch of other stuff I need to do, including I need to get up and exercise a little bit today. I've just basically been working all day today. But I want to thank you guys for coming on. And Stephen Kua, once again, I wanted to say thank you so much for the super chat. And like I said, happy to answer any questions. Today is Wednesday. I'll be back tomorrow, and I'll be taking Fridays off as usual. Thank you very much, and I will see you tomorrow.